So in this episode, we're going to be talking about time frames, higher time frames, trading off of higher time frames for direction and bias, and then dropping down to lower time frames for entries to magnify our reward for risk ratio. Meaning, if using just a higher time frame, we were able to get maybe a 1-to-1 or a 1-to-2, using the higher time frame coupled with the lower time frame for sniper-like entries, we're able to take that 1-to-1 or 1-to-2 to a 1-to-4 and a 1-to-5 and so on. And so we're amplifying the profitability of the system, or maybe even bringing a system that would otherwise be negative into profitability. So on the left of your screen, you see a 1-minute chart of the ES. This out of the scope of this video because we'll cover it in other episodes, but this is what I call, this blue box is what I call a support, an SR zone. SRZ is the way I abbreviate it. Support resistance zone, which is a very specific way of coming up with these zones, which we'll cover in another video. And this is representative of that. So these are actual zones. And then the reversal candlesticks we've spoken about in the prior episode, episode 1. So just go back and check that out if you need to. And that's the way we're going to be entering these trades. But caveat emptor, the entry isn't so simple. For the purposes of demonstrating, giving you proof of this Matrioshka effect of trading timeframes and how you can amplify your gains using the Matrioshka effect, I'm just going to take reversal candlestick entries, but just know that that's not the way I enter. There are some filters, and we'll cover that in another episode. So I've got it on global, so that as we move on the 15-minute, which is on the right here, the 1 minute will follow along. So if you go to your 15-minute and you see this SRZ, support resistance zone, and it breaks, and we will talk about how I use the SRZs in another video, but this zone is here, it breaks and comes back to retest, and I'm looking for an entry here, or in this box basically, to go short until it doesn't work anymore. Then if I just were to take the 15-minute chart, I would need to enter here, which is 99.50. Again, just trust me on this, that the stop placement would be 8 points away. Again, we'll talk about that in another video. So if we did enter on the close here, 8 points away is 407.50, and we would get about, this is 2-to-1 here, this green line. So short from here, stop here, we get about 1, just over 1, or about 1 R in favor, come back and stop us out. So the mass favorable excursion on that trade would have been 1. You come in here, it's 8 points here as well. You enter on the close of that candle, 8 points is there. It would go up, not get our stop, come down, again 1 hour in favor, and you get the gist. Now, if we go over to the 1 minute chart, which was dancing around while I was showing you that, you can see I've already put on the risk to reward tool. Because we're on the smaller time frame, the stop, again, we'll talk about in another video, would be 3 points, 2R in favor is right there. As you can see, the trade probably went 3, maybe 4, about 4R, because if each one's 2, 96 is the 4. Right there is 4R, and maybe here is 5. So where we had 1-to-1 before getting stopped out, we got 5-to-1 here. Again, if we go to here, we got a 1-to-1 here. But if you entered randomly on reversal candlesticks, which I don't, you would have probably entered right there. The stop would have been 2, and you'd have been stopped out. No, wait a sec, maybe you wouldn't have even been stopped out there, even just blindly shorting at 7.25, your stop would be there. And again, there's the 2-to-1 and beyond, where on the larger time frame, it was just a 1-to-1 before being stopped. We got a 2, maybe we got a 3-to-1 before being stopped. Here you got a 1-to-1. So I can show you a couple more examples. We're already 5 minutes into the video, but that's the idea. Let's go back over here and see another one. Here's another one. If you were shorting here, again, the support resistance zone breaks, you come pull back in, and you go on the first reversal candlestick, this is 5 points. 5 points is here. You get a 1.5 to 1 maybe. Goes from here all the way. That's a reversal candlestick that comes down there. That's more than halfway. So over 1.25, 1.5, then comes back and stops you out. But on the 1 minute chart, if you wait for the 15-minute to close where it needs to close on this candle, 14.15, and then wait for the pullback into the area, then on this occasion, if you take the first reversal candlestick, you get a stop out. But bear in mind, even though you got a stop out and the other one went 1.5 in favor, you have to look at the whole sample size. So if we're going short the first here, we would be going here, 2-point stop is 13, and it goes about 1 to 1 in favor. So that's no different to the 15-minute chart on this occasion. If you take the next reversal candlestick, which may very well have been this, just going without any entry model, then yeah, you'd still get stopped there. But if you waited for this one, you got a ride down. So this one didn't work out, but as you can see, 1 out of 2 would have just gone the same distance as the 15-minute chart. 2 out of the 3 went way further. And so that's the idea. That's why the Matrioshka effect amplifies your trading. And this is one way to keep things, I've called this series criteria of consistency. This is one way to consistently amplify your reward to risk. And do so in this video didn't really demonstrate the consistency, but in other videos you'll see how this Matrioshka effect ties in with the other principles. Just as a heads up, the next video will most likely be about the support resistance zone, how to measure it, when it's invalidated, when it's validated, and how to use it. And then probably we'll move on to the idea of volatility and the ATR stop. But that's getting a bit ahead of ourselves. I'll end this video here. I'll catch you all in the next video. Take care and bye for now.